Let's then kick off with a question about the Chinese yuan and this change by the PBOC making it cheaper and easier to short the yuan in terms of not having to put aside 20% of reserves in terms of sales for FX derivatives. What are the broader implications, not just for the currency, but for Chinese assets more broadly?
I think the market is likely to interpret that the PBOC sees the recent appreciation a bit being too fast. And remember, in September 2017, the PBOC did cut the RRR, and so the CNY-USD exchange rate paused for about a quarter, and then it appreciated again in Q1 2018. And that appreciation trend was reversed when U.S.-China trade escalation took off in 2Q 2018. So I think, depending on the horizon, probably some near-term pause, but medium-term, it's still quite supportive view on the CNY. So I think, given the carry is still very high, like you mentioned, I think maybe short-term momentum eases a bit, but medium-term, it doesn't change the broader picture.
How do you factor that in, then, to your short-term and medium-term view when it comes to Chinese equities?
Yeah, that's a good question. So short-term, we're cautious because we're in the final weeks of U.S.-China, tension because the U.S. presidential election. So this could still be a period with tension. So we try to underweight the areas that are exposed. So, for example, tech hardware, internet, U.S.-listed ADR, it's hard to predict what may happen beyond what's already taken place. But what we try to overweight are sectors and stocks that are more insulated from that. So we stick with sustainable growth names in consumption, healthcare, education, internet, renewables. And we also have potential turnaround cases in value, such as telcos. And we also have some strong cyclical growth names that are also being held by sector consolidation, such as the material names. So the underweight areas are potential U.S.-China conflict, heavy counters, and then also underweight Chinese banks. Yeah, we marginally raised cash in our model portfolio to about 6% vis-a-vis 5% a month ago.
Right, Wendy, that's 6.2%. I'm just looking at the makeup of that model portfolio. What also stands out to me, and you touched on this a little bit, I'm wondering if you could expound it a little bit more, compared to the benchmark and compared to where you were in the previous version of this portfolio, you guys really don't like the banks. Why not?
Yeah, I think we discussed on your show that our view on banks for about 2 years now. I still see interest on the banks because the cheap valuation. But if we look at the big picture, if the banking sector is to rebalance to vis-a-vis the rest of the ecosystem, then they need to show revenues being right-sized rather than earnings falling, because the revenue is the cost of credit to the rest of the ecosystem. So I think we're probably still got ways to go in the sector's right-sizing. And if you look through the weighting, there's another sector we like, which is tremendously out of favor, and that's the Chinese telcos. They're at less than 2 times 2020 EV/EBITDA, when the consensus are indicating EBITDA is going to grow, and the revenue and pricing has started to improve. But I think it's just that people have been disappointed with the sector for so long. There's not enough interest in this space.